Today's webinar. Welcome to FMA's Fabcast, a series of interactive web-based instructional seminars. Today's Fabcast is titled Economic Outlook and will be presented by Dr. Kuehl. This webinar is sponsored by DHJJ, and my name is Stephanie Corona, and I am FMA's host for this program. FMA is a trade association that serves the metals industry. FMA unites thousands of metal fabricating and manufacturing professionals around a common purpose: to shape the future of our industry and in turn shape the world. To do this, we built a workforce lifecycle that supports individuals and businesses at every point in their development. And to learn more about FMA membership and upcoming events, please visit fmamfg.org. So next is a few housekeeping reminders before we get started. FMA utilizes Zoom webinars. Today's webinar is designed to be interactive, so we are going to keep the phone lines unmuted to allow discussion and interaction. When you are not speaking, we do ask that you keep your computer sound or phone muted. Please keep in mind that this session is going to be recorded. The recording will be available a few days after the webinar has been completed, and you will receive an email with a link to the recording. With that, I'd like to continue by introducing our sponsors, Stephanie Ganzi from DHJJ.
Thank you so much, Stephanie. Yeah, we have two Stephanies on here. So welcome, everyone. Thanks for joining DHJJ Certified Public Accountants, Business Advisors, and Financial Advisors, as well as the FMA on this webinar. My name is Stephanie Ganzi, and I am the Marketing Director at the firm. Our CPAs and advisors watch how the market and policy changes impact our clients, and then focus on how we can help with outcomes through tax planning, financial strategy, and business advisory. Our goal is to make your business stronger and your life simpler. I would like to introduce Ed Brooks, a principal in our firm who specializes working with manufacturers. Ed has over 32 years of experience and brings a lifelong passion for understanding what drives success in business to his role in helping entrepreneurial clients and company leaders. He knows how to take on the routine tax and compliance responsibilities while managing the initiatives that help businesses grow. With that, I'd like to turn it over to Ed Brooks. Ed?
Thanks, Stephanie. And FMA, thanks for putting this on. We're happy to sponsor it. We really enjoy the insights of Dr. Kuehl. Part of managing a business is understanding what's happening in the world. Strategic decision-making is a big part of what Dr. Kuehl brings to or helps business owners get insight into what is happening out there in the economy, especially on a global level. DHJJ is a CPA firm founded in 1974 in the Chicago area, specifically Naperville. We have more than 100 employees. We have employees in 5 different states. Our clients are located throughout the United States. We do focus primarily on privately owned business. So one unique thing about us is we are, we're just focused on family-owned businesses, entrepreneurs, and with a special emphasis on industrial companies. With being Midwest-based, we do have a lot of clients that are, tied up in the industrial world in some way, whether distributors, fabricators, manufacturers. It's something we work with every day. Another point is, yes, we do the tax and compliance work, as Stephanie mentioned, the accounting, the audits, the reviews. But I think the difference is our business acumen and the consultative approach we bring to that relationship. The other thing is, we started out as a local firm, we're national now, but really, I think a good way to kind of understand our culture is we're a local firm. We deliver a local firm service model with regional firm resources. And we think that's what's needed for most businesses today. Having said that, let me introduce you to Dr. Kuehl. Chris serves as an economic analyst for the FMA. One of his major roles at FMA is writing an economic e-newsletter titled Fabrinomics. specifically designed to aid business decision-making by management and shop owners in the metal forming and fabricating industry. Chris also conducts workshops for FMA at major conferences and trade shows. He is the managing director of Armada Corporate Intelligence. He is the editor and publisher of a daily e-publication, Business Intelligence Brief, distributed by chambers of commerce and business organizations around the world. It deals with business and economic trends and how they affect strategic decisions. He also serves as the economist for the National Association for Credit Management and various state CPA societies. Chris holds a PhD in political economics, a master's in East Asian studies, and a master's in Soviet and East European studies. He was a professor of international economics and finance for 15 years prior to founding Armada. He taught in the US, Hungary, Russia, Estonia, Singapore, and Taiwan. And today we get to get his insights. So Dr. Kuehl, turning it over to you.
All right, thank you very much. I will bring my screen up so we can see my oh so very exciting slides. Let me see here. Well, always fun to find the right slide. There we go. Technology, yay. So, speaking to you today as FMA's economist, and I noticed that, as with most people, Fabronomics always throws people. I have to blame the marketing people. It's Fabronomics because it's fabricating and economics. So it sounds good when you first start it, and then it's like you ask somebody introducing you to pronounce it, and they're like, what the heck is this? So it is an attempt to get to the heart of what matters to a manufacturer. And right now, I'm kind of in a good position because I'm speaking kind of in conjunction with two of my favorite areas. One is manufacturing and the other is accounting, because as mentioned, I do a lot of work with CPA societies in Kansas, Missouri, Tennessee, Kentucky, North Dakota, Minnesota, Wisconsin. It just goes on and on. So let me say at this point that it's really nice to be doing a seminar, webinar, instead of being in Fargo in January, which I usually get to do because that's when the North Dakota Society of CPAs has their meeting. So today we're going to talk a little bit about why economists are so bad at doing what they are ostensibly charged with doing. We are supposed to be forecasters. We are supposed to be people who can predict what's going to happen. And our track record for this last year has not been great. We have been consistently missing what has been going on within the economy. Now, we always have a reason to dismiss. We always have the same excuse that weathermen have, which is more data. We got more information, so it changed the situation and, of course, changed our assumption. In every single quarter where we have missed our assessment, there's been a good reason. We have something that has occurred that we didn't expect, or we didn't expect it to have quite the impact that it has. So as we go through this, be aware that a lot of what happens within the economic realm is flexible. We're constantly dealing with new things, some of them very huge, things like the 2020 pandemic, things like the Russian invasion of Ukraine. A lot of times they're a lot more subtle, little shifts and little changes and things that really have a tremendous impact on a particular sector. So now that I've given you all the disclaimers necessary, we'll launch into this and talk about what we think about. The first thing I want to point out is something that's fairly obvious, but it bears repeating. We're a huge country. We're the largest economy in the world by a long shot. Remember a few years back when people were saying, oh, China is going to take over and China is going to be the biggest economy and we're going to be in second place. Nobody's saying that now. China is in a world of hurt. They have an awful lot of issues that are going to be very difficult for them to solve. Not that they're going to be in a collapse situation or even necessarily a recession, but that advance that was taking place for 10, 20 years, that was kind of the process of becoming a developed country after you have been a developing country. You can grow very fast when you're coming from basically zero. And once you become a developed nation, like the United States, like Europe, like Japan, problems tend to accumulate and slow things down a bit. Every single state in this country corresponds to a country when it comes to GDP. So you can find your state on the map and figure out what you correspond to. But it's a reminder of just how potent this country is from an economic perspective. You have my own state of Kansas, which is compared to Ukraine, which is amazingly apt because a lot of the things going on in Ukraine revolve around the fact that the eastern side and the western side are very different. The eastern side is Russian, the western side is Ukrainian, kind of like Kansas. Eastern Kansans don't like western Kansans, western Kansans don't like eastern Kansans. The western side of my state has tried to secede 5 times. It has failed 5 times, but the impetus is still there. But you see the point. I mean, Texas has the same GDP as Canada. And by the way, Indiana has the same GDP as Russia. So as we are concerned about what's going on in Russia and the sanctions, just be aware that it's the size of Indiana. What we end up with in this country is sector recessions. We rarely get a real national recession. There's always a part of the country that continues to grow. There's always a sector of industry that continues to grow. By the same token, we always have a sector that's not doing so well. Even when the country as a whole may be growing, there's going to be a region that's behind, that is suffering particular economic setbacks. You may have industries that have more struggle than ones that are progressing. The point is that we rarely end up going in the same direction. And that's very important for manufacturers because manufacturers are serving all of these other sectors. So even as you start to see a bit of a decline in, for example, few years back, it was the aerospace sector. You know, travel was down. 2020 was a disastrous year for travel in the aerospace sector. Any manufacturer that was connected to that was experiencing that same decline. Reversal today, aerospace is now booming. We have a tremendous amount of pent-up demand to travel. The airlines are desperately trying to get back up to their normal levels. They're purchasing aircraft, et cetera. So the manufacturers experience the same boom and bust that fundamental part of the economy is experiencing. So here's the proof positive that we don't know what the heck we're doing. Back in 2023, if you had looked at this chart a few months back, you would have seen a prediction for Q3 of recession. We were looking at maybe at best 0.4% growth, more likely a negative number. We were looking at the same thing for Q4. What we actually got was 2.6% growth in the third quarter and 2.9% growth in the fourth. So even as this was being updated, it was still falling short. What happened? What was it that drove those 2 quarters? What is it that was driving Q1 and Q2 of this year? Because again, we were predicting recession. What we got was 2.3% growth in the first quarter, 2.3% growth in second quarter. We're now looking at third quarter numbers. Latest that have come from the Atlanta Fed in their GDP Now study, 3% growth. So where is the recession? What did we do? How are we continuing to dodge the bullet quarter after quarter? Third quarter of last year, it was manufacturing and it was exports. And this is my opportunity to kind of go into the manufacturing rant, not as needed with this audience as it is with many of the others that I speak to, which don't understand manufacturing. We are still a major manufacturing country. We always have been. this notion that we don't make anything anymore, that it's all from China or it's all from the developing world, that's not true, never has been. We still account for 40% of the value of global manufacturing. And the reason we still account for that much is that what we make is incredibly expensive. We make food planes, we make road building equipment, we make mining equipment. We make 92% of all the railroad engines made in the world. Now, figuring value is tricky because what you end up having to do is figure out finished value. And the reality is that many manufacturing processes are back and forth across borders dozens of times. We get parts from one place, we upgrade, we alter, we send it, it comes back, goes over again. Particularly if you look at our relationship with Mexico, which we're going to talk about more in a minute, the average car that is manufactured, at least partially in Mexico, has gone across the border 6 times. So as assemblies are added, changed, altered, it is affecting the finished product. We get credit for the finished product. So our manufacturing data reflects the fact that we're kind of at the end of that process. So Q3 was a boon in exports because the dollar had become slightly weaker. And because it weakened, the companies that buy the sort of things that we make, they wait for the opportunity to save some money. They wait for the dollar to be a bit weaker, and it was in Q3, so they bought more. Q4 was the consumer. And every single year, we go through the same process with the consumer. And it baffles me to no end that even though we repeat this every year, it always seems that economists are shocked. It's like, oh my gosh, who knew? What happens every single Q4 is that the American male saves Christmas. And we do this every year the same way. We have been studied by the Retail Federation to determine why and how we do this. We are convinced that Christmas will not be on the 25th. We are convinced that it is going to be sometime in March, and we have plenty of time to shop. Suddenly, it occurs to us that Christmas is in 2 days, and we have not bought anything for anybody. The National Retail Federation did a study a number of years back and discovered that of the men who shop the last 2 days before Christmas, fully 50% of what they purchase is bought at a convenience store. So you have desperate men giving their loved ones, a scratcher's ticket, a Slim Jim, a 6-pack, because, hey, they didn't realize Christmas was in 2 days. The reality is that we buy junk and we give it to our loved ones, and they take it back to the store and exchange it for something they do want and spend 2 to 3 times more than we spent. If we thought we were being clever and gave them a gift card, there's nothing says, I love you, honey. We've been married for 30 years. Buy yourself something nice. He does and spends 4 to 5 times the value of the gift card. But every year, we send a surge of angry women into the store to exchange the nonsense we bought them for something they want. And it boosts retail, and it does every year, like clockwork. It's been doing it for decades, and it did it again last year, and it'll do it again this year. So now we're into 2024. We had the same issue in the first quarter. Exports were up, which ended up boosting growth to about 2.3. Q2 was the consumer again, and this time it was that the consumer was spending on spring stuff, clothing, outdoor activity. We saw a really strong travel season this year. We saw people going on vacations again. They were buying recreational equipment. This was one of the best years in the last 5 or 6 for boat purchases. It was one of the best years for a whole series of sporting categories because people were back doing what they had done in previous years. So we're on track this year to get into, like I said, 3% growth third quarter, maybe close to 3% in the fourth quarter. So there you go. We try to predict based on what we're seeing in the past, but if you get something new that begins to develop in the quarter that you're examining, well, you end up having to revise your numbers. So the bottom line at this point is that we're still running over 3%, much above initial expectations. Again, the recession threat is reduced. Global growth is not as robust as it was, but it's still 3.5%. Even Europe has managed to avoid recession. They're not booming. 1.1, 1.5 is not exactly setting the world on fire. And if you had seen the predictions last year, they were miserable. There was an expectation that Europe was going to have one of the worst recessions it had seen since 2008, maybe even as bad as 2020. Well, it didn't happen. There were mitigating factors. We were expecting a really disastrous weather year, that it was going to be cold, and with the sanctions against Russia, etc. Well, it turned out not to be as bad a winter as anticipated. Europe did not experience the decline it thought it would. All of this goes into decision making when it comes to rates. So the Fed is very likely to raise rates at least one more time. They're probably going to do another quarter point, maybe in November. The mantra for a central bank is that it raises rates until it breaks something. Once it has broken something, it thinks about lowering rates to fix what it was it broke. So the way that it tracks whether it's broken anything is generally employment. When it starts to see the unemployment rate come up, then it's determining that we've done enough. We've done enough to slow the economy. But they look at growth overall. So the Fed's looking at the potential for 3% growth, saying, well, we obviously haven't slowed the economy very much. We certainly still have room to slow it if it's growing at 3%. We thought it was going to be in recession for the last 4 quarters, and it hasn't been. So maybe we can still keep pushing rates up until you start seeing some response within the economy. The Fed still has latitude. We'll talk more about that in a minute. We've seen positive activity in a lot of areas. We still see strong non-residential construction. Now, the caveat there is that it's strong this year. They're worried about next year. The pipeline for 2024 is quite small. Right now, they're finishing up projects and they're working on things that started 1 or 2 or 3 years ago. But those are coming to completion, and there isn't a lot that's coming down the pike to keep them as busy next year. So there's a little bit of trepidation with the construction sector. Automotive is still strong. The UAW strike may affect that. So we don't know how long that's going to last. We don't know quite even which automakers are going to be most impacted. We'll come back to that too. Aerospace is still booming. The defense sector is booming. We're aware that we're spending an incredible amount of money trying to support Ukraine after they've been invaded by the Ruskies. What we don't seem to understand is that 93% of that money never leaves the United States. We're not sending troops. We're not paying the Ukrainian troops. What we're doing, we're arms dealers. We're sending them weapons. And I work a lot with the military. I'm the red team economist for the military. They're kind of ecstatic about this, saying, what we're doing is getting rid of a lot of our old stuff, and now we can buy new stuff. We're also using weapon systems that we weren't really sure worked, and now we're kind of like, oh, I'll be darned, they do work. So the military is kind of like, yeah, this is not a bad deal. We refer to the military-industrial complex, and we have been for 50 years. What that means is that it's civilian companies that make stuff for the military. So when we're spending money on defense, we are basically propping up our own industrial sector. That's been booming for all kinds of reasons. Consumer spending has been stable. We'll come back to that too. Global commodity inventories are still generally low. You still have a lot of trepidation with steel producers and copper producers and even lumber producers. I mean, everybody is not quite sure what next year looks like, so they're cautious. They're not cutting production necessarily, but they're not speeding it up until either. Since a lot of you do business in Mexico, I want to talk a little bit about Mexico, not in great detail, but just to point out a few developments of interest. Growth is quite respectable. It's 5.4%. It's going faster than we are. Industrial production is up. The role of oil has remarkably shifted. That used to be almost half of what Mexico exported. Now it's much, much less. And it's not that they're really sending much less oil to us. They still do. It's just that manufacturing exports into the U.S. have really increased. I mean, manufacturing is now driving the Mexican economy very aggressively. Retail sales are up 3.5%, much stronger than expected. The middle class in Mexico is spending just the way it is here. The unemployment rate officially is very low. It's important to understand that some of the data can be key. The Mexican employment numbers are always a little funny because almost half the country is not even in the system. You've got people who are living in rural areas, areas where they're just not connected to the economy, so they're not accurately counted. We sort of have that in the US. If you look at, we do our economic reports based on the data that comes from the Bureau of Labor Statistics, and the BLS has 6 different cuts of the data that they produce. The one that we always see quoted is U3. U3 is the simplest of the 6 because all it is people who are formally on unemployment. They're getting an unemployment check in the system. But we also have U6. U6 is another cut that comes from BLS, and it picks up the discouraged worker, the person who's out of work, not in the system, not getting unemployment, and may have at some point, but it expired. It also picks up the involuntary part-time. People who would rather work a full-time job can't find one working part-time. U6 is almost always twice U3. So if we're talking about 3.8% unemployment at the U3 level, at the U6 level, it's almost 8%. So even within the United States, we have a little bit of challenge figuring out who actually is employed or not. The next few charts are things that Armada puts together, and we've been doing this now for 5 or 6 years. Just a quick preface with this. I wish I could take credit for the metrics that we use, but this is put together by a partner of ours who has a extremely interesting background as far as modeling and predicting. He is a retired lieutenant colonel, used to be in the artillery. And when he was in the artillery, he pointed out that accuracy was really, really, really important. He developed a very complicated system to track his shells. He's adapted that to the industrial economy. We look at manufacturing because that is the focus of a lot of what happens economically in this country. 22 different metrics that combine to give us, and I'm not kidding, 99% accuracy quarter after quarter. The orange is the predicted behavior, the blue is what has happened. So if you look at industrial production in general, we're still seeing some growth. We'll see a bit of a dip coming in the beginning of next year. We'll talk about why in a minute, but it reverses and reverses pretty quickly and pretty aggressively. The very latest version of this, which we just did for July, is beginning to push that even further. And the August data that we're seeing so far, I haven't quite got it completely put together, is pushing it even further. If you look at non-residential construction spending, look at that curve. I mean, that's been on an exponential drive now for several years and is still way above trend line, even though you've seen a little bit of a decline in some of that construction spending. And that goes to the point I made earlier, that as a sector, it's all over the place. If you're in the business of building office buildings, you're in recession because there's no demand for them. I mean, office occupancy now is less than 50%. I mean, it is a victim of 2020. But if you're building for logistics and supply chain, you can't keep up with demand. If you're building on the residential side, if you're building single family, you've seen a decline of 25%. it is falling through the floor because there's no demand. If you're building multifamily, it's up 25%. So it just depends on the sector that you're focused on. Again, the manufacturing, getting more specifically to manufacture, again, jumping over that line and becoming a lot more aggressive going forward. So the August numbers here show growth going through the rest of this year into the beginning of next, and then continuing to resume that rate later in the year. Machinery, big important sector for FMA members. And what's happening here is always very connected to capacity utilization. So when you're looking at what drives machinery, it comes down to how efficiently you're using what you already have. Capacity utilization, ideally, you want to be somewhere between 80 and 85%. If you're under 80%, well, you have slack. Your machines are not working at capacity. Your workforce is not as productive as it could be. Over 85%, now you're starting to run into bottlenecks. You're running into delays. You're overtaxed. Over 85%, people start buying machinery. They start hiring because now they're dealing with more demand than they can handle. We have been hugging the very bottom of capacity utilization, I guess, acceptability for the last month or so. We've been at 79.7, 78.9, month after month. We're right almost to 80. A couple of months we've even gone over 80. And we fall back to 79 point something. So we're right at that point where we would be in normal. And if we start to get over 85%, that's the trigger that starts making people think about adding capacity, either people or machines or both. The UAW strike is the kind of the latest wild card where we're trying to figure out all kinds of things. How long is it going to last? We know that every 10 days, this strike is costing about $6 billion to the economy, getting to the point that it will start dragging half a point off of GDP growth. A lot of the really critical issues are kind of not in the press. I mean, it's typical union negotiation right now because you talk about things that are sort of way out there and they're negotiation points. And then you're able to start moving back towards, a center. The union comes down a little bit and the big three come up a little bit, et cetera. But behind a lot of this is the issue of job security. The very day that the UAW talked about going on strike a couple months ago, there were 5 major investments made in manufacturing in Mexico that day. It was sort of like, well, if this is going to happen in automotive, we need to be prepared. And that was providing an impetus for that investment. The other thing that we're becoming more aware of, as far as geopolitics is concerned, is the interconnection we have with other countries and their manufacturing sectors and how it fits into their politics. Biden just recently did a visit to Japan and South Korea. What he wants is those two countries to work with us to counter China. Now, working with Japan, no problem. Working with South Korea, no problem. These countries get along with us just fine. They're allies. The issue is they don't get along with each other. The Japanese and the Koreans have been antagonistic towards each other for 2,500 years, if not longer. We want them to work together. We want them to cooperate. And they're like, yeah, well, fine. What's in it for us? We've hated each other for centuries. And we basically said, well, if you promise to work more efficiently with one another, we'll give you better access to our auto sector. You can start bringing in more Kias and Hyundais and Toyotas and Suzukis and Hondas. So the UAW is saying, okay, that's a threat. And we need to have some conversation about how much of that's going to take place, even though we understand the geopolitical part of all this. We also have to recognize that these 3 car companies have very different leadership. Ford is already working with the unions. They're the most vulnerable of the 3 because they do the most production here. GM is right behind. Stellantis is a whole different story. This is the combination of Chrysler, Jeep, and Fiat. Their CEO is European, and he has been through much more bitter union discussions in Europe than we have ever seen. He also points out that the vast majority of Stellantis production is outside the United States. It's in Europe, it's in Latin America, it's in Asia. And he points out, he said, look, if push comes to shove, I'll just cut you loose. I'll shut down production in the United States altogether. I don't need you. I make all that I need to make in Europe, in Latin America, in Asia. So go ahead and push it, and I'll just sit you down. So that particular point of the big three is going to be a challenge because the big three in the US is not the big three internationally. The three largest car companies in the world are not Ford, GM, and Stellantis. It is Volkswagen, Toyota, and Honda. So this could be an interesting development. There could be relatively quick solutions, maybe within the next few weeks, or it could drag on for months. So some of the headwinds that we've talked about consistently have been inventory related. We've seen a lot of accumulation of inventory, and we know why. I mean, companies reacted to the 2020 crisis by laying in more stuff than they'd ever done before because they didn't want to get caught short. And very few companies are now at a too low inventory level. This messes up the reorder cycle. Manufacturers are counting on those clients to come back to them and reorder, and there's a cycle. They know that they would work through the inventory by such and such a time, then they come back to the manufacturer and say, hey, I need more of this. Well, that reorder cycle has been shot to heck because of the carrying of inventory. We have seen job openings fall, but not because we're hiring. We're seeing it fall because companies are no longer offering them. They're basically saying, what's the point? There's nobody taking these offers anyway, so why are we continuing to even offer the jobs when we know we can't find people to fill them? And the workforce issue is something I've been haranguing about for years. I mean, it's just like a broken record. We're short people in manufacturing, we're short people in construction, and we know why. There's no great secret to this, but it's just not easy to fix. I mean, the number one issue is simply retirement. By the end of this decade, the entire boomer generation will have reached retirement, all 76 million of us. Now, boomers have been pledging this for years because we've never had lives and we just work. And we can do that into our 60s and 70s, but then, you hit your 80s and all of a sudden you want to enjoy your golden weeks. So we suddenly start seeing people actually retire. We don't have replacements for them. The next generation up is Gen X, and that's the smallest cohort after the largest cohort. Now, millennials are now becoming the largest cohort because boomers, despite their every effort, are dying anyway. And eventually millennials will take over. But after the millennials comes another small cohort, and that's Gen Z. So we've got this roller coaster when it comes to people. The other thing to be aware of is the number of people who have been able to essentially lay out of the workforce or find other ways to make a living. For example, I give a lot of interesting talks to a lot of interesting groups, and I was speaking to the Dry Cleaners Association. Like I said, I've got some real interesting groups. This year alone, I've spoken to the Vinegar Institute and learned that balsamic sales are down. I also spoke to the National Watermelon Promotion Board and helped them understand that watermelon consumption goes up in the summer. Amazing, isn't it? There's good money to be made in pointing out the obvious. So that was my contribution to the watermelon people. But when you talk to the dry cleaners, they said that one of their biggest concerns was internet laundry. And I said, what the heck is internet laundry? And they said, internet laundry is based on the fact that 5 to 7 million women that were sent home during the pandemic to take care of their kids because the schools were closed, had to do something to make money. And they discovered that they could advertise on the local internet that they would do other people's laundry. And the average take home was $350 a day. So now you have a woman that can go back to work, the minimum wage job, $15 an hour, make $120 a day and pay taxes, or keep on doing other people's laundry for $350 a day, and the only people that know she's doing that are her and the person whose laundry she's doing. So that's become an alternative. It's like Uber and Lyft. It's a big type job, and it takes people out of the formal workforce. We don't even quite know how to count people like that because they're not employed, but they're making money. They have a job. It's not a formal job, and it's not a way that we can count. Even a lot of the Uber and Lyft people, when you ask them, are you employed? They frequently say, no, I don't have a job. What do you mean you don't have a job? You've been driving that car every day for years. I mean, according to your little profile, you've got 17,000 trips. Yeah, but it's not a real job. Don't have a boss, don't have to. If I don't feel like driving tomorrow, I don't. So how do we count them? We don't even know which category they fit into. So the Fed is continuing to look at inflation. They're still trying to figure out where it's going. They do not pay attention to the consumer price index. The CPI is a little flawed. It's a little bit artificial. It's based on assumptions. It's based on the fact that we know that an average family of four spends on something specific. So the challenge is there really is no average family of four now. We've got millennials and Gen X and Gen Z and boomers, and they're all spending differently. Their baskets don't look the same. So we don't quite know what we're actually measuring. The Fed will not pay attention to CPI. So even though CPI has come down and is looking at about 3% now, the Fed looks at this, personal consumption expenditures. PCE is much more accurate because it is what we actually spent and what it actually cost. But it's the actually part that matters. The Fed is currently looking at data from June, maybe a little from early July. They're not looking at the rest of July, or August, or September. There's a lag. It takes about 3 months to get this data collected and processed. And so the Fed is always almost a quarter behind. So even if inflation came down somewhat, the Fed won't really know that for 2 or 3 months down the road, and that will affect what they decide to do as far as interest rates. But it's important to remember the historical connection. Some of you in this audience, I'm sure, are of my vintage. I can't see you, but I suspect that there are people who remember the 80s. And you remember Paul Volcker. And you remember Paul Volcker coming to power as the Fed chair with the mandate, control inflation. And he said, I will. There's only one way to control inflation, and that's to hit the economy with a baseball bat until it's pulp. I'm going to raise interest rates by 20 points. If you want to kill inflation, that's the way you do it. You raise rates so high that businesses start to fail. They can't hire anybody. They get rid of half their staff with layoffs. If people are laid off, they can't make any money. If they can't make any money, they can't spend any. And if they can't spend any, then nobody can raise their prices, can they? But Uncle Paul, that's going to give us recession. Yep, 2, 3, 5, 10, maybe 50. I don't know. You may never get out of it. It's not my problem. You brought me in to deal with inflation. I did. Recession is somebody else's problem. That's the way you deal with inflation. You raise rates until you strangle the economy. And if you look at what we've gone through in the last several decades, where we are now is about normal. What was abnormal was having rates at zero, and we will never see them at zero again. That was an experiment in a sense, and it was a failed one. It created many more problems than it solved. Just take, for example, our reaction to 2020. what you would normally do if you had a recession, which we did in 2020, would be that you'd stimulate the economy by lowering interest rates. How do you lower interest rates when there's zero? So here's the Fed saying, we need to stimulate the economy. We're going to make it like really zero, like double years, like wow, zero. There's no place to go. It was already at bottom. So the silver lining now is that they're at 5.5, or will likely be at 5.5. Now, if they decide to stimulate the economy next year, they've got some room to do it. They can raise rates, they can also lower them, and they could lower them by a point or two and still have some room to do that. So lowering rates when they're rock bottom isn't a possibility. Lowering them when they're a little bit in respectable historical territory is an opportunity. And it's very likely that rates will start coming down next year. The consensus view is that they would probably start coming down early third quarter of next year, just based on past patterns. In the meantime, banks are tightening credit standards. We've all been experiencing this. But a little bit of a silver lining here, too. I talk to a lot of bankers, and the bankers point out we still have to loan. That's how we make money. We're not just, that's our business. We are risk takers. We are supposed to loan money. What we're looking for now is opportunities that are a little more protective, and that means they're more interested in manufacturers than they have been in years. Because when the manufacturer comes, they're looking to borrow money to buy a machine or to expand their facility. And the bank says, if you come in here wanting to spend a bunch of money on a new laser cutter or a new press brake, we call that collateral. And we're a lot more interested in loaning to you than we would be somebody that comes in and says, hey, I want to open up a new coffee shop next to Starbucks. Response to that guy is, don't let the door hit you on the way out. What's been affecting construction has been financing. And so there's a lot more trepidation about lending into the construction sector because many of these projects are kind of sitting there. But again, it depends. Right now, if you are looking at construction, the fastest growing sector of construction is manufacturing. It's up 73%. So office buildings, not very popular. Manufacturing, on the other hand, and we know why for that as well. I mean, it's reshoring. It's companies coming back to the United States. They need facilities. But it also has to do with what the manufacturer is now faced with when it comes to robotics and automation and technology. It's just as simple as I change my facility to accommodate what I'm buying. I mean, it's kind of a crack up. I've talked to a lot of manufacturers that have functioned just fine for years in some nasty cinder block building, which was unair conditioned and dirty. And, you don't like it, get a different job. Then they bring in the robots and the computers and they say, oh, I'm not going to work under these conditions. It's dirty and it's hot, and I'm a computer, and I don't like it hot, I don't like it humid, and I'm going to fail. I promise you. When the machines are like, I don't like dust, make me dirty, and I'm not going to work. So these companies are now like, okay, we need to upgrade our building to accommodate the robots and the computers. And all the people working there are like, are you kidding me? You made me work in this pit for 4 decades and you're upgrading because the computers and the robots don't like it? Sorry, guy, it's the robot apocalypse. You're just going to have to get used to it. We, as I mentioned earlier, we're overstocked, too much stuff, and that is going to be dragging on the economy, dragging on the industrial sector for at least another couple of quarters. Now, theoretically, we'll start moving through that inventory as we see continued growth, but that's going to kind of depend on the consumer. That's relatively good news. Retail sales are still going up because we are the most dedicated consumers on the planet. There's nothing that keeps us from spending. Every other country, when it looks at potential economic distress, consumers start to save. They start to become more concerned about the future. That's not how we work. Our attitude is, well, there's inflation. Things are going to get more expensive, so I better buy now. And I might lose my job later. And if I lose my job later, well, then I can't buy anything. So I better buy now. So as soon as we think there's going to be problems in the future, we spend like maniacs. It's like, well, because that way, if I get laid off, I will at least have a big screen TV to watch. So we spend more. I mean, the economy is threatening and we set new records for retail sales. Every place else in the world is going the other direction. That's good news if you're trying to draw that inventory level down and get back on that reorder cycle. Spending expectations have come down a bit from what they were in 2021, 2022, but not to the point that it's even below trend. We're still where we were in the last decade and a half, and it's probably not going to fall any further than that. What we have seen is a lot of that personal savings level dissipate. We had a tremendous amount of savings because of the 2020 stimulus. Don't even get me started on that recession. But you saw decisions being made that were not terribly well thought through. For example, let's do what we always do in a recession. Let's dump money on the consumer because the consumer will then spend their way out of the recession. Works like a charm every time. Unless, of course, you've closed everything. Then the consumer is like, okay, that's great, thanks for the money, but the stores are closed, the travel is shot, I can't be within 50 feet of my own relatives. What am I supposed to spend it on? There's nothing I can spend on. So our savings rate went from 6% to 38% in a quarter or two. That money has been sitting on the economy since. Now, most of it is now gone, at least for the bottom 2/3. The upper third, however, is still sitting on a lot of that extra money, and they're ones watching. What are they going to do with it? Are they going to start spending it more? Are they going to continue to invest it? A lot of that money ended up in what's referred to as the shadow banking system. These are non-bank financial intermediaries. They're insurance companies, they're venture funds, they're equity funds, they're angel funds, they're captive lenders, they're any group that is distributing money that is not under the control of the Fed. And they're still pushing money into the economy and at a rapid rate. I mean, the Fed at one point actually went to GMAC, which is a captive lender, and said, look, you need to quit making so many car loans. We're trying to control the money supply. And the GMAC said, do you know what the GM stands for in our name? That would be General Motors. And do you know what General Motors does? They make cars. Our sole function existence is to get people into GM cars. So no, we're not going to quit making car loans. We are not prepared to tank our core industry so you can help slow the economy. That is what limits central banks. They don't have control over all the money that's out there, and much of that money now is in that upper third. We've seen e-commerce continue to rise, which has been feeding all of that logistics and supply chain activity. Because if you're substituting the brick and mortar, retail has been down, but warehousing has been up because people are using different tactics as far as selling is concerned. One interesting development, and it's still very anecdotal, it's still not really backed up much with data, but Gen Z has begun to turn on e-commerce. And not in a fundamental way. They still use it a lot, but now there's a lot more interest in locally made products, smaller companies, smaller businesses, and it's coming predominantly from the Gen Z. And again, purely anecdotal, but I was in Greenville last week, and Greenville is now being held up as an example to cities all over the US on how to rebuild your downtown. 10, 15 years ago, according to the stuff they were telling me, it was a ghost town. There was nothing down there. There were 3 big malls that had taken all the business. 2 of those malls are now gone, and everything has shifted back downtown. And what's happening and what they've deliberately tried to encourage is the Gen Z relocate downtown, live in lofts, patronize the stores that are in the area. Gen Z is becoming somewhat European in terms of how they shop and how they function. The European model is people live in smaller homes. They don't go to Costco. They don't go to Sam's Club. They don't buy 9,000 rolls of paper towels at a time. They buy 1 roll as they need it. They buy food every day. They don't even make food at home very much. And Gen Z is not a big cooking generation. They've rejected the whole boomer idea of house in the suburb and mow your lawn and all that stuff. And Gen Z is like, why in God's name would I want to mow a lawn? So they're shifting some of what happens as far as e-commerce. The implication for manufacturing is that it kind of reintroduces some of that kind of small town, small merchant kind of mentality. But like I said, this is still very anecdotal, and e-commerce is still growing, so it's not like it's crushed it. So it's just something to watch. This may be the one slide that argues most vociferously against recession. Expenditures way up, and we know why. It's investing in robots, it's investing in expanded space, etc. Because now we're getting these technologies in areas we didn't used to see. We're used to it in manufacturing. We're used to it even in construction. But as I've been telling people now for months, I had my first experience with a service vending experience. Had my first experience with a server robot. I was in a conference hotel in St. Louis, go down for breakfast, order, get a little device, which I think is the pager to tell me my food is ready. Oh no, it's connected to Marge. Marge is a robot. Marge comes rolling up to my table wearing an apron that says Marge and cheerfully says, "Good morning. You ordered eggs Benedict, a glass of orange juice, and a cup of coffee. Would you please sample your coffee to see if it is the right temperature?" Best service I've gotten in months. The little robot cared about my coffee. So I talked to the guy afterwards and I said, "What possessed you to bring?" Well, it was the people I had to hire as servers. They didn't show up half the time. If they did show up, they were drunk or stoned or didn't care. And I've got 2 kinds of customers here. I've got business people like you, and I've got my elderly to come into play in the casino. Neither one of you want to be dealing with those kind of jerks. The elderly love Mart. They talk to her for 20 minutes. She doesn't say much, but she's a good listener. And it's something that is becoming more and more and more common. And we're beginning to see service robots showing up all over the place. I mean, Japan has been experiencing a revolution within elder care. We're using robots in assisted living facilities. So, and according to the polls, the people in the senior centers like the robots better than people. So new orders for durable goods have been cooperating. We're seeing good growth in things like computers, electrical equipment, automotive is still growing, defense sector is growing. A little bit of weakness in fab metals and primary metals, because as I mentioned earlier, those are the sectors that are beginning a little bit worried about what next year looks like. Like fab metals, very sensitive to what happens in the appliance sector. And they know that housing drives appliances. And so it's like, well, if housing is going to tank a little, high mortgage rates, high prices, we're a little worried. So you're seeing a little bit more trepidation there than in other sectors. If you look at how we compare with the rest of the world, and you're all familiar with the PMI, we're in pretty good company. 19 countries are in contraction, including us, but we're not deep. I mean, 47.9 is not great, but it's not critical. You're seeing continued numbers over 50 in Mexico. You're seeing dramatically good numbers in India. The numbers out of Russia, you cannot trust. That was an interesting little episode. The first set of numbers that came out had Russia in the 30s. Then they were withdrawn. And the people who produced those numbers seemed to vanish. And then new numbers came out that had Russia in the 50s. And when asked, why are your numbers so much better? It was kind of a version of, well, Mr. Putin said if numbers were not better, we were going to be in a plane that crashed. Like I mentioned in the beginning, I started out as a Soviet specialist back in the 80s, and underneath this placid exterior beats the heart of a Cold Warrior, and I still don't trust the place that I can't quit calling the Soviet Union, no matter how hard I try. So the bottom line with PMI is that it's reliable. We know that it's easy to read, and the most important thing is that purchasing managers don't know enough to lie and manipulate the data. They're basically asked simple questions. Are you buying more or less steel? More. How come? I don't know. I don't even know what we make. Somebody told me to buy more steel and we're out of toilet paper. I'm the purchasing manager. I don't know why I buy anything and I don't care. Somebody told me to buy X or Y and I do. You honestly think that as the purchasing manager, I'm going to go to my CFO and say, sir, why are we buying this? My CFO is going to turn to me and say, Binkley, shut up and do your job. So it's 100% data that is reliable. You just know where it's going and you can track how you fit compared to other countries. We're on top of things when it comes to oil. We're now the world's biggest oil producer. We're the biggest oil consumer. We're the biggest oil exporter. We are capable of getting up around 15 or 16 million barrels per day. Gap between what we produce and what we consume is filled with Canada and Mexico. We do virtually nothing with the Middle East or with North Africa anymore. The prediction was that prices were going to stay in the 70s. They have bounced up into the 80s because OPEC made the decision to continue cuts. But that's only going to be temporary. I was in Fargo when that announcement was made. And the good people of Fargo kind of looked at me and said, you know, that's pretty dang good news. OPEC is going to cut production. Hey, Vern, fire up. If we are going to be denied some of their oil, well, then by God, we'll just produce more of our own. And we are more than capable of doing exactly that. What was slowing down oil for a while was that investors were shying away from it because they were like, well, maybe we're going to go all alternative. That's now pretty obviously not the case. We're going to be fossil fuel dependent at least until 2070. And so the investment is now coming back into fossil fuels. Gas prices, diesel prices jumped up, hit some pretty record numbers, are beginning to start to come back down just a little. Transportation has started to become a little more predictable. We had 65,000 new trucking companies that came into existence last year, mostly because we had a capacity issue. There were 14 loads for every truck, and suddenly we started to see these fire up. There's no easier industry to get into. Manufacturing is not easy to get into. I mean, if you're going to set up as a new manufacturer, you've got to bit equipment, you've got to find a space, you've got to find people. It is complicated. It is one of the more difficult sectors to get into for an entrepreneur. Trucking, you all decide you want to be a trucker. You ask, what do I need? A truck. You get a truck in a CDL and you're a trucker. And suddenly the roads are full of mama you betchas, real good trucking. And you talk to the guy that pulls up. How long you been in this business? About an hour. That's the way it works. Now we're starting to see a lot of those 65,000 come out of the sector because after having 14 loads per every truck, now we're down to 2.7. And the prices have commensurately come down. one of the things that FMA tracks is logistics costs, and we do that with the FFJSCR. No offense, FMA, but that is the worst acronym in history. I mean, I try to pronounce it the FIFISGR, but it's unique. It is a great indicator because it's looking at small to mid-sized manufacturers. And we ask about investment, and we ask about what's going on with hiring. We also ask about logistics. And many of the companies responding were indicating, hey, logistics costs are starting to come down. And that's been one of our biggest concerns. So with that, I'm going to hush. Those of you who know me, know that I'm a tech guy. So who here understands the economy anyway? So it can get a little complicated. For those of you who just can't get enough, I can assure you that I am just as long-winded in print as I am in public. We do a number of publications. The flagship comes out 3 times a week. It sells for the same amount as 2 Starbucks caramel macchiatos. So it's not really expensive. We're doing a free trial for $7 a month. And that thing I showed you at the beginning that was looking at manufacturing and construction, that's the watch. And we have a free trial for 2 months on that one. So anybody who's interested in those things, let me know, and I will get you on the list, and I can clog up your email with my stuff. At this point, I'm going to shut up and take questions. I saw that there were some things in the chat, so I'll see if I can actually read these. So, see if my system is even going to let me. I'm going to get off of sharing so that I can. There we go. So somebody says they need to meet Marge. That's true. She was cute. And the return matched. The only real challenge I had with Marge is I wanted to leave her a tip, and I didn't know what to leave, so I just gave her some spare batteries. So that was the best I could do. Any questions?
We have an attendee with their hand raised. I'm going to go ahead and allow their Zoom account to speak. Let's see if our attendee is available to ask their question.
And if we don't get to you and you want to ask that question later, just send me an email. I'm as long-winded in an email as I am in anything else.
Attendee, if you're there, we have your account pulled up and we've asked you to unmute. And if you're not able to, go ahead and submit your question in the Q&A portion below and we'll be able to read it.
And Cindy has told you how to get the FFJSCR. And my only advice is talk to the Defense Department to get a cool acronym. I mean, so at this point, it just makes it, but it's intriguing. People want to know what a FIFISGR is.
You can see if Ed has any question.
I have removed the attendee for now, but go ahead and enter your question if you have them at the bottom of the screen. I'd like to invite Ed Brooks back if he has any questions for Dr. Kuehl.
I do, Doctor. I want to make sure I kind of read one of your charts correctly. It looks like you're kind of predicting negative or flat GDP. Is it Q1 and 2 of 24?
Not necessarily. If you're talking about that very first graph that I was making fun of, that's kind of the consensus among economists. And unfortunately, the consensus has been so consistently wrong that no one quite knows what to do with those numbers. This is a chart that comes out of the conference board, and the conference board is usually pretty good about collecting the ideas of economists. But as a rule, we have been predicting something to go wrong almost every quarter, and instead it's gone the other way. When we look at our own data, which is the stuff that's contained in the watch, and we've been watching what that's saying, we're looking for growth through this year and into next year, and even accelerating into the latter part of 2024. If we get a decline in certain sectors early next year, it's going to be because of that inventory. It's going to be the fact that the new order cycle is off, and companies that were expecting to see that demand are going to have to wait because the customer that they've reorder from is still working through inventory. Once that inventory is worked through, then they're going to come back to the up all the stuff we bought. I mean, to give you a good example that I ran into talking to a manufacturer is a faucet manufacturer. They had this huge order they were going to submit to companies all over the United States, multifamily units. All they were missing was the little disc on the faucet that said H or C. So you'd think by now consumers would know, hold on the right, hot on the left. You don't really need the little disc that says H, but without it, they couldn't ship the faucets. So when they finally got access to that stupid disc, they bought like 10 times more than they ever bought before because they didn't ever want to get caught like that again. But now, months later, the guy is like, oh, what was I thinking? What am I going to do with all these stupid discs now? You know, I've already fulfilled the order and now I have this massive these things. So he's going to have to get rid of those discs. But the company that makes the disc is saying, so that means you don't need to order anymore for a while? No, I've got millions of the stupid things and I'm not going to be able. So you take that and you multiply it by thousands of companies that over ordered. And that's where you get a bit of a dip in the first part of next year, but then it corrects because people work through the inventory at least as long as the consumers are still behaving the way we behave. So, see, I told you I could give long-winded responses.
No, that makes sense. It also, and when I look at that, this isn't, so I think there's a prediction of some, I don't know if mild is the right word, but short and not severe cycles through relative.
Yeah, and it fits more in it, you know, semantics matters, but we're probably realistically looking for something that would be better described as a downturn. Because in order for it to be recession, and this is again just the nomenclature that economists use, before the National Association of or the National INBER declares a recession, it has to be negative growth for 2 quarters in a row. And we're not heading anywhere near that. So even if we get a decline, at this stage, it's like maybe it peels a point off GDP. Maybe instead of 2.3, it's 1.3. But until it jumps below that threshold, below zero, and it does it for 2 quarters in a row, you're not formally in recession. And even when you do get that formal declaration, you then want to break it down by sector and by state. I mean, the last time we had a real recession in that respect, you know, the state of Texas came back and said, boy, that's sure a shame. Too bad all the other people are having a recession. We ain't. And we haven't had one in decades. So then it becomes a matter
I'm
of,
going to steal that term downturn because I do have some debates with clients about recession. And I think people have, you know, the 08, 09 recession is fresh
right.
in memories. And I'm not an economist, but I have been doing this a while. And
Yeah.
I am not, I think you go back to your most recent memory. And
Yeah.
I think downturn might be a term I'm going to kind of steal from you.
You bet. I mean, it's a good way of saying, look, you know, we're seeing some interruptions, and 2008 was a classic example of a real recession. I mean, 2020 was bizarre. You know, it was a manufactured recession. But 2008 is an example of what happens when the financial sector folds. Because no matter who you are, you get caught up in that. Because I remember 2008 going right up until the time that things began to turn south. Manufacturers were extremely confident. I mean, they were like, we have a book of orders. We're doing great. You know, we're doing perfectly well. Then they got clobbered because they couldn't get credit. And so you had all these manufacturers saying, we're doing fine, but our bank isn't giving us any money and we can't order inventory. We can't order material. We're going to have to renege on deals because the LIBOR rate went crazy. And so that was an example of when the recession is triggered by the financial sector, you have problems because it percolates through the entire economy. Luckily, right now, we're not dealing with a financial sector meltdown.
Yeah, it's a good point to keep in mind. And then employment, we're in a unique situation with employment. I've never seen it like this with, are we ever going to see unemployment rise significantly?
We may not, because we've got all of these different factors that are pressing on the traditional notion of employment. The number one thing is simply that we have this more or less permanent loss of workforce because of retirement. There's no easy way to replace that. It's not like we can just suddenly start finding people who've been out of work for a while. We used to use immigration, but we don't have the same system we had before. In the old days, you brought in people who had language barriers and skill deficits, and you found jobs. We really counted on their children because that was the generation that would have been educated here, etc. Now, many of the immigrants that are coming in, for example, we have never seen fewer Mexican immigrants. The immigrants that are coming into the United States are not from Mexico. They are from Latin America, Central America, really more defined as refugees than immigrants. I mean, I was talking to a guy that was installing a sprinkler system. And, where are you from? Venezuela. What are you doing here? Working illegally. How come? I'm an accountant in Caracas. I had my own farm, but I made the mistake of saying something critical about Maduro. And I became a persona non grata, and it was either get out of Venezuela or be killed. So I got out of Venezuela. What do I want to do? It's not putting sprinkler systems. It's to go back home and be an accountant. But somebody has to take that idiot out first. And it's like the second the government changes in Venezuela, 3 million Venezuelans go back home.
Thank you, Ed, for your questions. Dr. Kuehl, I do want to bring your attention to a few more questions that we have that we could
Sure.
briefly discuss. In the chat, we have our first one. The investment in automation by manufacturers continues to build and grow. Do you expect that to continue for many years to come? And do you think that will significantly drive improvements in productivity?
Yeah, that investment is definitely taking place just because of what Ed and I are just talking about. When you don't have the potential to hire workers, you got to do something. And the automation is going to continue, particularly because it gets more innovative. I mean, we haven't even begun to talk about what AI does to technology. I mean, the things that it can do as opposed to what even robotics could do 5-6 years ago.
Thank you. And then we have another question. If the auto strike goes long, what happens to the economy? What do you expect UAW to win?
Yeah, it's likely not to go on forever. The pattern with a lot of union stuff is that it's often done right before the Christmas holidays because the pressure to settle becomes greater the closer you get to Christmas. You've got a bunch of workers who are making a fraction of what they made when they were working, and all of a sudden it becomes obvious that they need to make a trip to the convenience store to buy presents. And so they want to do their jobs. It also depends on what the consumer does. In past years, there weren't a lot of options, but the consumer now is saying, well, okay, Ford, GM, Stellantis is, but I can buy a Toyota or a Volkswagen or a Hyundai or a Kia, and they're not on strike. And the sales for those are beginning to take off.
Wonderful. Well, that wraps up our Q&A portion for today, and that concludes today's webinar. Thank you for our attendees for participating in today's webinar, and we especially want to thank Dr. Chris Kuehl for sharing his business and economic insights, and hope that this helps our viewers be prepared in 2023 as it comes to a close. If you are interested in more education opportunities, please visit the FMAMFG.org website. And finally, I would like to remind our attendees that you will receive an evaluation via email. Please take a moment to share your feedback and any comments or questions that you have about the program. And if several people have joined you on the same link, please forward them the survey as well. And we thank you in advance for your future participation, and we look forward to seeing you at our next few events.
Good. Thanks for all your attention, and just feel lucky that my cat decided not to Zoom bomb because it was close throughout this. So
Guest stars are always welcome. And thank you
yes,
to DHJJ for sponsoring this webinar.
thanks.